Here at Insightful Value, we don't chase headlines. We hunt for undervalued opportunities. And Otter Tail Corporation just might be one of them. The stock has been under pressure, but what if that's not the whole story? This review is for informational and educational purposes only and should not be taken as financial advice. If you appreciate deep dive breakdowns like this, hit that like button and subscribe to the channel for more. Otter Tail Corporation is a unique blend of stability and diversity. The company operates in three main segments: electric utility, manufacturing, and plastic pipe production. Its electric utility business, Otter Tail Power Company, serves around 133,000 customers in the upper Midwest, delivering consistent, regulated revenues. The manufacturing and plastic segments provide non-regulated exposure to industrial and housing markets. So, why is the stock down? The plastics segment, which had been delivering outsized earnings during the supply chain boom, has come back to earth. Lower pricing and softer demand have pulled down earnings from that side of the business. That said, the utility division remains solid, with ongoing investments in renewable energy and infrastructure upgrades supporting long-term growth. In their latest quarterly results, the company posted revenue of around $300 million, with earnings per share dipping from last year's highs but remaining healthy relative to historical levels. Margins have tightened, especially in plastics, but the overall financial health of the company is still sound. Otter Tail maintains a strong dividend track record. It has increased its dividend for several consecutive years and currently yields over 2.5%. The payout ratio is conservative, allowing room for continued dividend growth even in less robust years. From a valuation standpoint, the price-to-earnings ratio has dropped below its recent averages, suggesting that the current stock price may not fully reflect the company's long-term fundamentals. The balance sheet is solid with moderate debt and sufficient cash flows to fund operations and dividends. Now let's talk risk. The plastics and manufacturing segments are highly cyclical and subject to pricing pressure, commodity costs, and construction trends. This creates earnings volatility. Additionally, the utility business, while stable, is exposed to regulatory delays and infrastructure costs, especially as it transitions toward more renewables. However, with that risk also comes opportunity. Otter Tail is planning further investments in wind and solar capacity and has regulatory support to recover many of those costs through rate adjustments. Why consider the company now? For long-term investors seeking a mix of stable utility income and cyclical upside from manufacturing, this dip could present a more attractive entry point. On the flip side, if economic conditions worsen or plastic margins continue to slide, earnings could stay suppressed in the near term. Dividend investors may still find comfort in the company's conservative payout and consistent performance in its core utility business. At Insightful Value, we specialize in finding companies like this, underappreciated, misunderstood, and full of potential. We break down the data, filter the noise, and focus on what matters. For more deep dives like this one, visit insightfulvalue.com. And if this video helped clarify Otter Tail's situation, give it a thumbs up and make sure to subscribe for more breakdowns.